In this session, we'll present the bank reconciliation and the petty cash. Bank reconciliation is to make the reconciliation between the bank statement and the cash book in the business. Bank use regular bank statement of account. Bank transactions recorded in business bank book are recorded by bank in the bank statement. The following table illustrates the process. So, any transaction recorded in the cash book related to the bank is recorded in the bank statement. We have the action, cash book, and bank statement. First action is deposit. We receive money. So, when we receive money, it's a debit entry in the cash book, and it's a credit entry in the bank statement. The bank considers the received money as liability on it, while the business is considered as an asset. Payment is the opposite. It's a credit entry because we are reducing our assets, we are taking from our cash, and it's a debit entry for the bank statement, it's reducing its liability. And then we have the left funds that have debit balance, and it's a current asset because this means that the business have cash. And for the bank, it's a credit balance and it's a liability of the bank. If it's overdrawn, this means that the business has borrowed money from the bank and it's a credit balance, it's liability of the business. The opposite in the bank, it's a debit balance and it's an asset for the bank. There are several reasons why difference exists between the bank statement and the cash book. First one is errors and omissions. Two things come here. Not recorded transactions in cash book by mistake, or some transactions were not informed to the business. A customer has done a transfer to the business, but to the bank, it was received in the bank, but it was not informed to the business. Timing difference, delay the recording in the bank statement. You do the deposit in the last day of the month, and it's recorded in your cash book while it's not recorded in the bank statement until the first day of the next month. It's like, also it's unpresented checks. Usually a check, you give it to the supplier, the supplier then presents it to the bank on the same month. Then we have take an example of bank statement. We have Triple S Bank, and the account number is 111101, and we assume that the account holder name is Triple Y, and the address is 11 ZZ Avenue, DT 31011. And the statement date is October 31st at a given year, 2001X. We have the date, details, debit, credit, balance. This is typical bank statement that you might see. There might be different forms, but these are the basic information. On October 1st, we start with the balance brought forward, that's $10,000 in credit. First transaction was credit transfer. Remember the types of transfer that we talked about earlier in the previous session. The credit transfer is $4,530 and it reduces our credit balance to be $5,407. Then the second transaction is October 28 and it's a direct deposit of $720 that increase the credit balance to be $6,190. Third transaction is a direct debit. The direct debit is the debit that's provided by the payee, but they provide the amount and the date to the bank to process the payment. So it's a $1,600 that's reduced our credit balance to be $4,590. Then we have dividend received. Dividend is paid for share of a stock that we'll study later, but the business is investing part of its money in stocks and the stock are gaining dividend. And the dividend received to the bank account of $50 that increased the credit balance to be $4,640. And the last thing, the bank was charging $20 of bank charges that reduced the bank balance, and the bank ending bank balance in the bank statement is $4,620. Let's go and see what the business has recorded in its cash book for the same thing. The balance brought forward, it happened that it's $10,000, it's the same, so which means that they ended the last month with similar balances. On October 29th, they had sales of cash sales that is put in the bank of $200. We haven't seen it in the bank statement, so this would be one of the reconcilable items. Also, they have done payment of equipment of $5,430. If you remember, we have similar amount here, but with little bit difference. Here it's $5,430, while the bank paid only $4,530. There's difference of $900. So we put extra amount here because the actual amount paid by the bank is less by $900. On October 27th, there was a maintenance paid of $235 via check. We haven't seen this. This is a check that was provided to the supplier but never presented to the bank. The carried forward balance is $4,535. It's different from the bank. So difference due to errors and omissions. Let's see. Difference due to errors and omissions. Error recording in cash book on October 25th, 5,430 was recorded instead of 4,530. So debit of $900 needs to be added to the cash book. So we need to increase the debit side by $900. This is the first one. Second one, unforeseen receipt of $720 that was received in the bank was not recorded in the cash book, needs to be included in the cash book as well. An unforeseen or overbooked payment for $1,600 on October 29th that was paid but was not recorded in the cash book because it was not informed to the business. The fourth one is dividend. The dividend received on October 31st of $50 was not recorded in the cash book. Same thing for the bank and charges. So we have 5 items that was not recorded. One is correction and the others were not recorded in the cash book. Then we have difference due to processing and other delays affecting payments and receipts. On an uncredited deposit of $200 on October 29. This is the sales that was not recorded in the bank statement. It's recorded in the bank book but was not recorded in the bank statement. Unpresented check, $235 on October 27. Bank reconciliation involved 2 stages. First stage is to update the bank book with unrecorded transaction due to omissions or time difference. Corrected errors in the cash book, preparing bank reconciliation. Second one, preparing bank reconciliation. So we update the bank account. This is the bank account as we saw it earlier. We have the balance brought forward, 10,000, the equipment of 5,430, and the check 235, and the sales of 200. Then we do the first correction to this one. This one has to be reduced by $900. So October 31st, correct the equipment, $900. Then we have on October 31st, we received $720, and then we have dividend of $50. So these are all added to the debit side. Direct debit of $1,600 that's paid, so it has to be reduced from the balance, and the bank charges of $20. Now the new balance is $4,585. Instead of, how much was it? Do you remember how much was it? It was $4,535. Now it's $4,585. Now we want to do the bank reconciliation statement, and there are 2 methods. First method, start with the bank statement balance. Bank statement balance was 4,620. Then you add uncredited deposit of 200. Then it's 4,820. You deduct the unpresented checks, you come up with 4,585. That's the updated cash book balance. Again, you start with the bank statement balance, 4,620 from the bank statement. Then uncredited deposit, that's the sales, $200, total is 4,820. Then you deduct the unpresented check of 235, come to you with the balance in the updated cash book, 4,585. The other method is starting with the cash book balance, 4,585. Then you deduct the uncredited deposit, $200. It's in the cash book, so you need to take its effect. It ends up with 4,385. Then you add the unpresented check, you return it, eliminate its effect. Now the total is 4,620 as in the bank statement. So we have two ways to do the bank reconciliation. But before you do the bank reconciliation statement, which is the easiest part, you have to update your bank account. To update your bank account, your cash book, when you update your cash book for the bank account, you need to analyze all the difference between the bank statement and the cash book. Then you do the update, and then you do reconciliation with the updated bank account. This is the end of the bank reconciliation, and now we are moving to see the petty cash. The Empress system of petty cash. Petty cash is used to pay for small everyday items. Example is payment for cleaning materials. Any business will have small payments that happens every day, and it doesn't justify having a system for it except the petty cash. Petty cash is easy way to spend the money. We will see how it is working. We say that petty cash voucher is used to record small business expenditures, and the petty cash cashier or custodian authorizes the petty cash payment. So instead of having the finance manager or the finance director or the owner of the business doing this type of payment, we delegate it to the petty cash cashier who approves and spends the money. Sample petty cash voucher, this is the voucher number, you have the date, you have the item, and you have the amount and the total. And it's authorized by, this is the petty cash cashier, and this is received by the one who received the money. The business gives the petty cash cashier fixed amount of money. So we start by establishing the fund, giving fixed amount of money to the petty cash cashier. And it's called interest or cash float. Every payment is recorded in the petty cash book. At the end of the interest period, the fund will be refilled to the agreed sum. So we spend the money, and at the end of the interest period, we refill it with the spent money. All authorized PC vouchers must be entered by the petty cash cashier. Let's look to the sample of the petty cash book. We start with date, then details, and we have the receipt, fund, and we have the date, details, voucher number, amount paid. So this is the credit side, this is the debit side. We started on 3rd of November. We received cash of $80. This is the fund. Now we start spending. On 3rd of November, for cleaning, voucher number 1, we spent $11.70. On 4th of November, we spent money for tea and coffee, that's voucher 2, and it's $40. 6th of November, we spent taxi, and it's voucher 3, and it's $8. And 7th of November, we bought newspaper, voucher number 4, $4.03. So the total is 64, and the remaining balance of the 80 is 16. So the balance carried forward and brought forward on the beginning of the next week, that's 10th of November. Then The refilling is 64 coming from the bank, so we start with $80 a. This is the paid amount, and there is a use of what they call analyzed petty cash flow, because manager want to know how much is spent on each type of the expense. So this is the amount paid, copied from the previous page, 1170 for cleaning, and 40 for tea and coffee, what's called sundry as a category, and the $8 for the taxi, and $4.30 for the newspapers, and the total of these is 64. And with this, we have ended the petty cash. We'll see you in the next session, and that will be talking about general journal. Thank you.